What if everything you were told about earning more money was a lie, and the reason you're still broke has nothing to do with your paycheck? Here's the uncomfortable truth. In America alone, 28% of adults earning over $100,000 a year live paycheck to paycheck. Not people making minimum wage. Six-figure earners, doctors, engineers, corporate managers, people who worked hard, got the promotions, and still can't figure out why the money disappears. Today, we're breaking down the exact 7 money habits that are silently bleeding high earners dry, with real data, real examples, and real fixes you can start today. If you've ever wondered why your income went up but your bank account didn't follow, this is the video you've been waiting for. Let's get into it. Here's a scenario that plays out millions of times every year. Someone lands a raise, maybe it's $20,000 more per year. They feel great. They deserve it. So they upgrade the car, move to a nicer apartment, start eating at better restaurants, book a few extra vacations. And 12 months later, they're saving almost exactly the same dollar amount they were before the raise, sometimes less. This is called lifestyle inflation, and it is arguably the single most destructive financial force in a high earner's life, precisely because it's invisible while it's happening. The data is staggering. According to a 2023 PYMNTS and Lending Club report, 36% of Americans earning between $100,000 and $150,000 annually describe themselves as living paycheck to paycheck. That number climbs even higher among certain demographics. And a separate survey by Schwab found that Americans believe you need to earn around $186,000 per year to feel financially comfortable. Yet even people earning that amount often report feeling financially stressed. Why? Because spending scales with income almost automatically if you don't have a system to stop it. Think about Shaquille O'Neal, who has been remarkably candid about this. He's spoken publicly about blowing $1 million in a single day after signing his first NBA contract. One day. He was 18, he had more money than he'd ever seen, and his lifestyle immediately exploded to match it. Now, Shaq recovered and built real wealth, but most people don't have a second act that generous. The fix is something called paying yourself first before lifestyle has a chance to inflate. The moment a raise, bonus, or income increase hits your account, automate the difference into savings or investments before you can spend it. Behavioral economists call this pre-commitment, and it works because it removes the decision entirely. A simple rule: for every dollar of income increase, allocate at least 50 cents to wealth building. The other 50 cents, enjoy it. You earned it, but protect that first half aggressively. If you've been doing this every time your income rose over the last decade, the compound difference would be staggering. Lifestyle inflation doesn't feel like a mistake. That's what makes it so dangerous. It feels like success. There's a sentence in Morgan Housel's best-selling book, The Psychology of Money, that should be tattooed on every high earner's wall. He writes, "Spending money to show people how much money you have is the fastest way to have less money." Read that again. Because it cuts to the core of one of the most widespread and devastating habits among high-income earners: status spending. Status spending is the act of purchasing things primarily to signal wealth or success to others, rather than for genuine utility or happiness. We're talking about the $80,000 leased luxury vehicle, the $500 dinners, the designer wardrobe, the prestige zip code apartment with the rent that stretches the budget to its absolute limit. The numbers are brutal. According to the Federal Reserve's survey of consumer finances, the median net worth of families in the top 10% of income, people earning well over $150,000, is $1.9 million. That sounds impressive until you realize that a large subset of high earners have net worths significantly below that median. In fact, research from Thomas Stanley and William Danko, the authors of The Millionaire Next Door, found that the majority of actual millionaires in America drive used cars, live in modest homes in middle-class neighborhoods, and spend significantly less than they could afford to. The real wealthy aren't performing wealth. They're building it quietly. Meanwhile, a study published in the Journal of Consumer Research found that the primary driver of luxury goods purchases among high earners wasn't personal enjoyment. It was social signaling. People were spending money they needed for wealth building in order to impress people they often don't even particularly care about. The trap is psychological. Our brains are wired for status comparison. Psychologists call it keeping up with the Joneses, and in high-income circles, the Joneses are driving Porsches and taking business-class flights on the company card. Social comparison becomes a spending arms race, and no one wins that race except the luxury brands. The fix starts with a single, honest question. Am I buying this because I genuinely want it and it adds real value to my life, or am I buying it to be seen? Start tracking every discretionary purchase over $100 for 30 days. Classify each one. The data will be uncomfortable, but uncomfortable data creates change. Comfortable feelings keep you broke. Here is a statistic that should shake you awake. According to a 2023 Vanguard study, the median 401k balance for Americans between the ages of 45 and 54, people who should be in the prime of their wealth-building years, is just $87,571. For context, most financial planners recommend having 6 to 8 times your annual salary saved for retirement by age 55. If you're earning $120,000, you should be approaching $720,000 to $960,000. The average reality is less than $90,000. High earners are falling into a paradox. The more they earn, the more complex their financial lives become, and complexity creates paralysis. More decisions to make, more accounts to manage, more options to analyze, and so they delay. They say, "I'll figure it out next quarter," or "I need to understand the market better before I invest." And the quarters turn into years. This is called analysis paralysis, and it is costing people fortunes in lost compound growth. Let's put real numbers to this. If you invest $1,000 per month starting at age 30 in a broadly diversified index fund with an average historical return of 8% per year, the S&P 500's long-run average, you'll have approximately $1.75 million by age 65. Wait until age 40 to start. That same $1,000 per month at the same return gets you to around $702,000. $10 years of delay costs you over $1 million, not because you invested less money. The difference in contributions is only $120,000. The $1 million gap is entirely compound interest that you forfeited. Warren Buffett's partner Charlie Munger was famous for saying the first rule of compounding is to never interrupt it unnecessarily. And yet high earners interrupt it constantly, by waiting, by overthinking, by keeping cash in savings accounts earning 4% when the market has returned an average of 10.13% annually over the last 50 years. The actionable fix is to automate your investments the same way you automate your bills. Set up automatic contributions to your 401k at the maximum allowable limit, which in 2025 is $23,500 for those under 50 and $31,000 for those 50 and above. Then set up automatic contributions to a Roth IRA, $7,000 per year for those under 50. Make investing as automatic and thoughtless as paying rent. Remove the decision. Remove the delay. The market rewards action, not perfection. Stop waiting to learn more. Start with a low-cost total market index fund, Vanguard's VTSAX, Fidelity's FZROX, or a simple S&P 500 ETF like VOO. One fund, automated, monthly. That alone puts you ahead of the majority of high earners who are still figuring it out. Ask a high earner if they have debt, and there's a good chance they'll say yes and then shrug it off. Because in high-income circles, debt has been completely normalized. Student loans, car loans, home equity lines of credit, business loans, multiple credit cards, it all gets filed under manageable debt and ignored as long as the minimum payment's clear. But here's what that normalization is hiding. According to the Federal Reserve, total household debt in the United States hit a record $17.5 trillion in 2024. Credit card debt alone crossed $1.17 trillion, also a record. And the average interest rate on credit card debt is hovering around 21% to 24% annually. That means for every $10,000 sitting on a credit card, you're paying $2,100 to $2,400 per year in interest, money that is producing absolutely nothing for you. Not a single asset, not a single dollar of growth, just gone. Here's the behavioral trap. High earners often have higher credit limits, better interest rates on loans, and more sophisticated-sounding debt structures. So the debt feels different, more under control, more strategic. But debt at 7%, 12%, or 21% is still wealth extraction regardless of how sophisticated the instrument sounds. Consider this. If a high earner carries $40,000 in debt at an average interest rate of 15%, a very common figure when you blend car loans, student loan balances, and credit card debt, they're paying $6,000 per year in interest. That's $6,000 that could be invested annually. Over 20 years at 8% returns, $6,000 per year invested compounds to approximately $297,000. They aren't just paying interest on debt, they're forfeiting $250,000 in future wealth. Dave Ramsey built an empire on one concept: debt is the enemy of wealth. Now Ramsey is considered extreme by many, and there are nuanced arguments for leveraged investing and mortgage debt, but the core principle holds. Consumer debt is a wealth destroyer, and treating it as a permanent feature of your financial life is a guaranteed path to remaining broke regardless of income. The fix is a tiered debt destruction plan. List every debt you carry, its balance, and its interest rate. Any debt above 7% should be treated as a financial emergency and attacked aggressively. Use the avalanche method, pay minimums on everything, throw every extra dollar at the highest interest rate debt first, then cascade down. Calculate the exact month you become debt-free on this plan. Write it on your wall. Make it real. Because debt freedom is the foundation that makes every other wealth-building strategy actually work. A 2022 study by Schwab found that Americans with a written financial plan are 2.5 times more likely to feel financially stable and 1.9 times more likely to save consistently compared to those without one. Yet according to a Northwestern Mutual survey, only 35% of Americans have any formalized financial plan, and among high earners, the numbers are only marginally better. Think about that. People earning $150,000, $200,000, even $300,000 a year are managing their entire financial future based on vibes, rough mental estimates, and vague intentions to invest more and save better someday. They have a detailed plan for their next product launch, their quarterly sales targets, their fitness goals, but not for the single most important system in their life, their money. This is not a complexity problem. A financial plan does not need to be a 40-page document prepared by a CFP. It needs to answer 5 questions. What is my current net worth? What is my monthly cash flow, income minus all expenses? What are my specific financial goals and their timelines? How am I allocating my income across spending, saving, investing, and giving? And what is my debt elimination timeline? That's it. 5 questions with honest, specific, written answers. Here's why written matters. A 2015 study by psychologist Gail Matthews at Dominican University found that people who wrote down their goals were 42% more likely to achieve them than those who didn't. Writing creates commitment. Commitment creates consistency. Consistency creates compound growth. The wealthiest people in the world are obsessive about financial scorecards. Ray Dalio, founder of Bridgewater Associates, the world's largest hedge fund, has spoken extensively about radical transparency in tracking financial performance. He treats his personal finances with the same rigor he applies to his fund. Not because he needs to obsess over every dollar, but because precision thinking about money is what separates wealth builders from wealth wasters. Your action step this week: open a spreadsheet or use a free tool like Mint, YNAB, or even a simple Google Sheet. Write down your net worth, every asset minus every liability. Write your monthly income and every expense category. Write 3 specific financial goals with dollar amounts and target dates. Then review this document every single month. 30 minutes per month. That's the entire time investment. But those 30 minutes will compound into hundreds of thousands of dollars over a lifetime. Here's a financial reality that most high earners refuse to fully confront. For someone earning $200,000 per year, federal income taxes alone could consume $40,000 to $50,000 or more of that income annually, depending on filing status and deductions. Add state taxes in states like California or New York, and you're looking at an effective tax rate that could easily reach 35% to 40% of gross income. That means you might be working from January through May every year just to pay your tax bill. Taxes are almost always a high earner's largest single expense. Larger than housing, larger than transportation, larger than food, larger than everything. And yet most people spend exactly 0 minutes per year on legal, proactive tax optimization. A 2023 report by TIGTA, the Treasury Inspector General for Tax Administration, estimated that the IRS misses billions in legal deductions that taxpayers simply fail to claim. Not tax evasion. Legal deductions that people don't know about or don't bother to capture. Let's talk about specific legal strategies that high earners consistently ignore. First, maxing out tax-advantaged accounts. If you're not maxing your 401k at $23,500 for 2025, every dollar you put in there reduces your taxable income dollar for dollar. Max that before anything else. Second, health savings accounts, HSAs, are triple tax-advantaged. Contributions are tax-deductible, growth is tax-free, and withdrawals for medical expenses are tax-free. The 2025 contribution limit for a family plan is $8,550. That's real money. Third, if you have any side income or self-employment income, a solo 401(k) or SEP IRA allows you to shelter enormous amounts of additional income from taxes. Consider this example. A high earner in the 32% federal tax bracket who maxes their 401(k) at $23,500 saves $7,520 in federal taxes alone in a single year. Over a 20-year career, that tax efficiency compounds dramatically. Warren Buffett famously noted that he pays a lower effective tax rate than his secretary due to strategic use of capital gains treatment versus ordinary income. Buffett isn't advocating for unfair tax policy. He's illustrating how powerfully tax strategy impacts net wealth accumulation. The fix here isn't complicated, but it does require one thing high earners often resist: paying for professional guidance. A good CPA or fee-only financial advisor who specializes in tax planning will cost you $1,500 to $5,000 per year. But they will routinely identify $10,000 to $30,000 or more in legal tax savings for a high-income earner. That is the highest return investment you can make. Stop doing your taxes on TurboTax in February and calling it financial planning. Tax strategy is a year-round discipline, not an April exercise. This final habit is the one that will be the most uncomfortable for people who consider themselves financially responsible, because it challenges the idea that extreme frugality is the path to wealth. Here's the mathematical reality. There is a ceiling to how much you can save. If you earn $80,000 per year and live on $40,000, you're saving $40,000, and that's exceptional discipline. But $40,000 per year invested over 30 years at 8% returns gets you to approximately $4.9 million. Solid, respectable. But the person who earns $300,000, saves $150,000 per year, and invests it at the same return. They accumulate $18.4 million over the same 30 years. 3 times the savings rate, 3 times the wealth. Income is the variable with the highest ceiling, and most people stop aggressively working to raise it after they hit a comfortable salary. According to the Bureau of Labor Statistics, median earnings for full-time workers in the United States are approximately $58,000 per year. The gap between median and high income isn't just lifestyle, it's financial trajectory. Every additional $10,000 in annual income, properly deployed, adds hundreds of thousands of dollars to your lifetime wealth. Consider Sarah Blakely, founder of Spanx. She started with $5,000 in savings and built a billion-dollar company not by cutting expenses more aggressively, but by building a revenue-generating asset. She optimized the income variable, not just the spending variable. And for people who don't want to build companies, the income optimization still applies. According to LinkedIn data, people who change jobs on average earn 10% to 20% more than those who stay at the same company and wait for annual raises. The average annual raise in 2024 was 3.5%, roughly in line with inflation. Job switching, by contrast, often yields 15% to 30% salary increases in a single move. Beyond salary, building a secondary income stream is no longer optional for serious wealth builders. Dividend-paying assets, rental real estate, a monetized skill, digital products, a small business. Any of these can meaningfully increase your income ceiling. According to IRS data, the majority of millionaires have multiple streams of income, on average 7. The habit to break is the passive mindset that says, I have a good job, that's enough. The habit to build is relentlessly asking, how do I make this income machine more powerful? Optimize expenses, yes, but simultaneously and aggressively raise the income. Both levers pulled together create exponential wealth growth that neither lever can achieve alone. If this video made you look at your finances differently, even just one of these habits, then the algorithm did something right today. But here's the thing. Knowledge without action is just entertainment. So before you scroll to the next video, do one thing: subscribe to WealthLogic. Because this channel exists for one reason: to give you the real, data-backed financial education that school never did and your employer never will. Every week we break down complex money concepts into clear, actionable strategies you can implement today. Hit subscribe, turn on notifications, and let's build something real. Here's your challenge for the next 24 hours, not the next week, not someday. The next 24 hours, pick one, just one of the 7 habits we covered today. Write down which one is costing you the most money right now. Then write one specific action you will take tomorrow to start fixing it. Not a goal, an action. Open the account, make the call, write the numbers down. Compound interest doesn't care about your intentions, it only responds to action. And the best time to act was 10 years ago. The second best time is right now. The gap between high earners who build wealth and high earners who stay broke isn't intelligence, it isn't luck, it's habits. And habits can be changed starting today. We'll see you in the next one. Personal finance, wealth building, investing tips, passive income, financial freedom, high earners broke, money habits, financial independence, financial mistakes, how to build wealth, money management, index fund investing, retirement planning, tax strategy, lifestyle inflation description. Are you earning good money but still struggling to build real wealth? You're not alone. In this video, WealthLogic breaks down the 7 dangerous money habits that keep high earners broke, with real statistics, named examples, and actionable fixes you can start today. We cover lifestyle inflation, status spending, investment avoidance, debt normalization, financial planning gaps, tax blindness, and the income ceiling trap.